Good Wednesday morning. Hope everybody is doing well. Would like to introduce Chelsey to kick off our fall year-end tax tips and tricks webinar. We've got a few questions in, and I think we'll answer quite a few as we go along. Hopefully you'll learn something. So I'll turn it over to Chelsey to carry on from here.
Derek. I know most people also know Derek, but in case you don't know him, speaking with Derek Duca today, and we are both financial planners at Asante Financial Management of the Duca Wealth Planning Group. So before we get into the agenda, just a couple housekeeping items. So you will notice that you are both muted, or all of you are muted, and your cameras are off. So please keep it that way throughout the presentation as we are recording it. As we are recording it, we will be having the replay available for listening at later time. If you have to step out at any time today or would like to re-listen. And then at the end of the webinar, you'll have the opportunity to ask questions through the chat box on Zoom. So if you can think of any questions during the presentation, please just put them in the chat at any time, and then we'll answer them all at the end. So our agenda today, we're going to briefly discuss Canada's tax system and how it works specifically in Ontario with a few examples. We'll then walk through the 4 Ds of tax planning, our personalized year-end tax optimization process, and finish off with some important tax changes for 2024. So Derek, please start us off with Canada's tax system.
All right. We have what's called a progressive tax system in Canada. It's not as beautiful as this wonderful scene that we're seeing here, but it's ultimately even more complex than our system of nature. So let's take a look at what progressive means in Canada. What it really means is we're going to look at this as you go through certain income thresholds, you will move into what they call a new tax bracket. And so the higher your bracket, the more tax you pay. So they're progressively taxing you. That doesn't mean you pay it all the way back to $1, but you do pay that, and we'll run through an example. And there are 2 separate rates. We're focusing on Ontario because that's where most of our clients are and where we are. So you'll see that there are federal and provincial tax brackets. We're not going to go through all these numbers in a lot of detail, but I'll focus on a couple of things. You can see on the top, it talks about the federal tax brackets. So the taxable income range of just over 55, actually just under $56,000 is the lowest federal tax bracket. You would pay 15% tax on the first $56,000 worth of income to the federal government. And if you look down below, you'll see that you would also pay an additional 5% tax to the provincial government. Now, it's all collected on one tax return, unless you're in the province of Quebec, which they have a separate tax filing system, but we're in Ontario. One other thing you'll notice is that, as with so many other things, the federal government and the provincial government don't exactly mesh on how things go. So the first 56,000 on the federal government is taxed only at the 15% level. It's the lowest tax bracket. But if you do have $56,000 and you're just right at that top range of the federal bracket, you've actually crossed over into a second tax bracket in the province of Ontario. You'll have about $5,000 taxed a little bit higher than you would if you stayed at $51,000. So again, you've got this intermingling and crossover. So instead of being, 3 or 4 tax brackets, we end up with like 13 or 14 tax brackets with different corresponding things. So let's take a look at how we calculate your taxes. And Chelsey's much better with numbers than I am, so I'll let her go.
Thanks, Derek. So we're going to review the basic formula for how your taxes are calculated. And there are 4 main categories that you will notice, or you might have noticed when going through your tax returns, which are total income, net income, taxable income, and tax payable. To start off, to get your net income, you take your total income from all of your income sources and you subtract your deductions. So this could be things like RSP contributions, carrying charges, or split pension amounts. And then to get your taxable income, there are additional deductions that are taken off of your net income. And these could be things like capital gains deductions. And then finally, to receive your tax payable, you multiply your taxable income by your average tax rate. And we're going to get into marginal and average tax rates shortly. Now, your tax payable and your actual tax due or tax refund on filing typically don't equal each other because there are tax credits that reduce your tax payable. Now we'll get into deductions and credits in more detail also later on, but we're just going to break down the differences between net income and taxable income. You might be wondering why there are certain deductions that reach your net income versus then additional deductions to reach your taxable income. And there is actually some key points as to why the government does this and why they need to differentiate them. So net income is used to determine your eligibility for certain income tested benefits like the old age security. And some income types, while not taxable, are considered when applying for social benefits. For example, if you were injured at work and you receive workers' compensation, this is an example of a non-taxable benefit that is still included in your net income, so it would go towards your old age security eligibility. But because it's included in your net income, it isn't affects your OAS eligibility, but it won't be included on your taxable income as there's an offsetting deduction. Now, just to go over the old age security clawback, not everybody is aware that there is actually a clawback. So what that means is the government starts taking back, so deducting taxes off of your old age security for every dollar that's over about $91,000. And for every $1 over, your old age security pension is reduced by 15 cents. Now, the amount of your clawback is based on your previous year's tax return. So, for example, if your 2024 net income is $100,000, your old age security will start to be clawed back in July of 2025. So you'll file your taxes in April, and then your OAS will be adjusted in July. The maximum old age security as of January 2024 is $8,560, and you would have approximately $1,350 clawed back if your net income was $100,000. Now there are also a maximum income threshold. So if you're under the age of 75 and your income's over 149,000, 100% of your old age security would be clawed back. And if you're over 75, it would be your income threshold would be 155,000, where 100% of your old age security would be clawed back. Okay, so that's net income and taxable income. Now let's look at marginal versus average tax rates.
Just before we go on there, Chelsey and I often shock our clients when they come in and say, our goal is to make sure that you have all your old age security clawed back. And they look at us a little surprised, and because most people aren't familiar with the amount of money it takes, we say, if you can't get by on $300,000 a year, we have a totally different problem than being concerned about paying taxes. And so it would be nice to be in that situation, but not everybody is. So anyhow, marginal and average tax rates. So the marginal refers to those buckets that we go on the next dollar of income. So that's if you have $50,000 of income, what are you going to pay on the next dollar? Or if you have $80,000, what are you going to pay on the next? Whereas the average tax rate is you take the total tax you pay and divide by all of your income to give you an average over the whole thing. So graphically, it's represented here. You can see the different brackets. The blue dotted line, you jump up and you go from paying very little to paying significantly more, but your average rate goes up much more gradually. So let's take a look at an example. We've got this handsome single guy, looks like me a few years ago, $60,000 salary.
Yes.
So what's...
Yes, so I'll walk through Brian here. So Brian, as Derek said, he's a 35-year-old individual. He makes $60,000 a year salary, and we're just going to assume that he has no other income. So we're going to look at the combined federal and provincial tax brackets shown on the left-hand side and the corresponding tax rates for Ontario and Canada on the right. We then break it down by dollar value of how much of Brian's income is within each tax bracket. So you can see there's two larger chunks. The first largest chunk is about 16,000, which is taxed at 0% marginal tax rate, and another big chunk at the 20% marginal tax rate with smaller incremental amounts in between those. We then multiply the dollar value of his income by the tax rate and receive Brian's total tax payable. Again, assuming no deductions, Brian's tax payable would be about $9,600. The actual tax he would have to pay would be based on what tax deductions and credits he receives to help reduce that tax payable. Going back to marginal and average tax rates, we've highlighted in orange the marginal tax rates. And with Brian's income at $60,000, the marginal tax rate on his next dollar earned is about 30%, whereas his average tax rate is about 16%. So if you ever find yourself looking at your income and saying, oh, I'm making $80,000 a year, that must mean I'm paying 30% in taxes from dollar one. While that is only true for every dollar earned over 80,000, and as you can see, up to 91,000 on the marginal tax brackets, the actual tax you are paying overall is likely closer to 20%. Now, there are a number of ways you can minimize your taxes, and the most common method is by using tax deductions, which we'll get into shortly. For now, we're going to switch into different forms of investment income.
So yes, one of the common misbeliefs is people say, oh, well, I'm going to pay 50% in tax. Now, while there are some tax brackets that do exceed 50% in Ontario, 53.3 or 53.5%, sorry, is the maximum tax bracket in Ontario, but you have to be upwards of $220,000, $250,000 worth of income in a given year to hit that tax bracket. And of course, the average tax rate, as Chelsey has so nicely explained, won't be anywhere near that. You're only going to pay that on the next dollar of income above that high tax bracket. So we talked about salary, but what about other forms of income? Most people will have some other form of income. So we're going to take a look at the most common types of investment income. And looking at this picture, we're going to work from right to left, showing you which ones pay the most tax. And so the one where you pay the most tax is if you earn interest income, if you've got a GIC or you earn some money sitting in a bank account or interest from a bond or bond fund, it's going to get taxed exactly as your salary. 100% of it shows up as taxable income. If you have mutual funds that invest outside of Canada, there will likely be some foreign dividend or foreign income included in that. And again, that's just like interest income. It gets fully taxed the same rate that your salary does. Now, there are some federal foreign tax credits. If the underlying federal or the underlying foreign mutual fund did pay taxes to another entity, you will get somewhat of a credit, but that goes beyond the scope of this simple example here. That'll be worked on as you do your taxes. Then there are a couple of advantageous forms of earning investment income in Canada. If it's a Canadian corporation, there's two types of dividends that you could earn. The first one are non-eligible dividends. And what they mean by non-eligible is that if it's a small privately controlled Canadian corporation, they pay a lower rate of tax and you can take dividends from it. And now there is a dividend tax credit that reduces the amount of tax that's payable, but excuse me, but you have to gross up the income. And so for every dollar that you receive in a non-eligible dividend, you have to report $1.15 on your tax return. Then we have what they call eligible dividends, which are if you own Bell Canada or any kind of Canadian corporation that pays out a dividend, and this is in a taxable investment account. So this is not inside your RSP, RIP, or TFSA. This is in just a regular investment account. You get a dividend tax credit, which offsets quite a bit of the tax owing on it, makes it much more favorable than interest income. And we will see later on where this can also negatively impact your OAS clawback, because for every dollar of dividend income, eligible dividends you receive, you have to report $1.38. So it really bumps up your net income, even though you get an offsetting tax credit. Then we have capital gains. Typically, people own stocks or mutual funds in their taxable account. When they sell it is when they would trigger a capital gain. And that's the profit that you made. If you bought something at $10 and sold it at $20, you've got a $10 gain. You only have to report 50% of that on your taxable income, so $5. Now, in 2024, and we'll talk about this a little bit more detail later on, they changed the inclusion rate where you now may have to include up to 67% or 2/3 of the capital gain in your taxable income, but that's only after the first $250,000 of capital gains per person per year. So not going to affect that many people unless they're selling a cottage or a business or perhaps a rental property they've had for many years and have a huge capital gain. And lastly, we have return of capital, which there, especially through some real estate investment trusts or real estate investments, you can have some money returned to you and it's tagged as return of capital. And if it's returning your own capital, the government says, well, you're just getting your own money back. You don't owe any tax on that. So that doesn't happen very often. And what you are actually doing is you're deferring taxes because you'll ultimately end up paying taxes later on, but it's a nice way to receive income in the short term. So let's walk through an example of what this would look like. Let's go back to Brian.
Yeah, so that was a lot of words. So let's put it into a picture format. Sometimes that's a little easier to understand. So Derek, can you now break it down through these different incomes on the table?
Okay, let's take a look at this sharp guy. I think he's smiling a lot because he thinks he's getting return of capital. But this is putting $60,000 into his bank account, gross. I shouldn't say gross, into his bank. Here's $60,000 of cash that he's receiving during the course of the year. If it's all from employment income, he's going to show $60,000 as taxable income. If it's from interest or foreign dividends, he's still going to show $60,000 of taxable income. If it's from eligible dividends, he's actually going to report $82,800 taxable income, way more than what he actually got. If it's non-eligible dividends, he's going to report $69,000 worth as taxable income. If he reports it as capital gains, he's only going to report $30,000. And of course, if it's return of capital, he's going to be really smiling and report no taxable income. So what does that mean as far as the tax owing? So as we saw from that first example, employment income that Chelsey took us through in detail is going to owe $9,627. Same thing with interest and foreign dividends. It's exactly the same as receiving more salary. The eligible dividends, even though he reports a much higher taxable income, because of the offsetting dividend tax credit, he ends up paying a much lower amount, only $2,047. Now, must put a caveat here. That's if he has absolutely no other income, because you're allowed to earn a certain amount of dividends with the offsetting dividend tax credit and your personal exemption that reduces taxes significantly. If he had any other income at all, he would end up owing more tax on his eligible dividends. But it points out the fact if that's all his income was, that's the only tax he would pay. Non-eligible dividends, you're reporting $69,000, but you're paying about half of what you would pay on employment income, $5,589. The capital gains, again, half because you're only reporting half of it, $4,815. And of course, the ideal return of capital. Don't we wish that we all could report everything as return of capital? So that's how the various different types of investments are taxed. Why don't you carry on now with the 4 Ds?
Yes. So the 4 Ds, as you can see here, are deduct, divide, defer, and diminish. And typically all tax planning strategies will fall under one of these 4 categories. So you can deduct taxes, as we've been talking about. You can defer taxes. You can divide taxes between 2 or more parties, and you can diminish taxes. And we are going to start with tax deductions. So like we talked about earlier, deductions reduce your taxable income. A few examples of doing that is strategically contributing to RSPs. It's one of the most common ones. If you have an open investment account, you can deduct certain advisor fees against your income. And I will bold the certain, not all advisor fees are deductible, so just caution on that. You can maximize rental expenses if you are renting out a portion or an entire rental property. Any expenses that you incur to operate the rental can be deducted against the rental income. And then another example is childcare expenses. Specific childcare expenses are also a tax deduction. Costs like daycare services or day or overnight camps may qualify. Just want to note here, obviously, a lot of these tax strategies are unique and based on each individual. So always consult a tax professional before implementing any of these strategies. Now, before moving on to tax credits, I will point out the main difference between a tax deduction is the tax savings on a deduction are based on your marginal tax rate. So the higher your income, the more tax savings you're going to get, versus the tax credit. The tax savings are based on the lowest federal or provincial tax rate, which is about 15%. So breaking down tax credits a little further, as we saw previously, tax deductions reduce your taxable income, whereas tax credits reduce your tax payable. And there are refundable and non-refundable credits, and the difference is explained in the names. Non-refundable credits will only refund any tax you already paid. So if you're in a refund position, then these non-refundable credits won't apply to you. And then there's refundable credits like the carbon rebate program, which you'll get no matter if you pay tax or get a refund. That. Now, Derek, can you explain for us how credits vary at different levels of income?
So we'll get into a bit more of a detailed example, but we'll go back to our example of Brian. He's in the 30% marginal tax bracket. So if he puts $5,000 into an RRSP, which would be the maximum that we would recommend, he's going to save 30% of that. So he's going to save $1,500. Tax credits, as indicated here, are typically at the lowest tax bracket. So if he's got $1,000 credit, that's going to go against $1,000 of his tax payable. And that doesn't matter if he's got a $60,000 income, a $40,000 income, or a $150,000 income. The credit is going to be applied at the lowest rate. Whereas with an RSP, if he was only earning $40,000, he would only get 20% tax savings because that's a low tax bracket. His bracket is 30%. But if you were up above 250,000 and you put money into an RSP, you would get over 50% in tax savings. So that's the difference between the tax credits and the tax savings. So let's move into one of my favorite things. I prefer peanut butter and honey, but the whole idea of this is how can we split income? How can we divide and conquer? And so pension splitting is one of the biggest things for those people that are in retirement or looking forward to retirement. You're allowed to split up to 50% of your pension with your spouse. And so we can use that to balance things out. And just a simple example, if you had $100,000 worth of pension income for one spouse and the other spouse had absolutely zero, that one person at $100,000 would pay quite a bit of tax because you remember those marginal tax brackets, they're moving beyond the 30% one into the next one above the $91,000. So two people at 50,000, as you remember from our slide, both of those would be in the lowest tax bracket. So there'd be significant tax savings. That's one of the biggest ones. Other ways of splitting pension income or splitting income would be to have joint investments. So if you have taxable investments outside of your RSP, TFSA, and so on, that produce interest, dividends, capital gains, if they're jointly owned, you can split the income between the two individuals, typically spouses. There's some little more sort of out there things for people that have significant amounts of money. You can do what's called a prescribed rate loan, where you loan money to an adult, could be a spouse, could be a child. You have to charge them. There's a rate prescribed by CRA as to how much interest you have to charge them. You have to report that on your income, but then they can invest the money, and all the income that they earn gets taxed in their hands, which presumably would be a lower income spouse or a lower income child, adult child. That gets into a lot of technicalities. So again, it doesn't apply that often. And now that prescribed rates have gone up because of the recent increase in rates, they went up pretty quickly. They haven't come down yet. So that's something to do much more likely when interest rates are much lower. In certain cases, if you've got lots of excess money, and we've actually done calculations for some clients with this as they're getting a little further along the road, said, I don't need all this money. We help them gift some money pre-inheritance to their children or grandchildren. Now, they no longer have the money, but they also don't earn the interest and don't have to pay the tax on it because it's not theirs anymore. That's another way to split things. That's the pension is really the big one, because that also works for RSP income. Once it's converted to a RIF, you can split RIF income. You can't split RSP income, but you can split the RIF income. So important things. We don't have to be quite as concerned with spousal RSPs and individual RSPs, because at the end of the day, we can now take RIF income and we can split it 50-50 with either person. So still some benefit in doing that for other tax planning reasons, but when it comes to retirement income, we can split 50-50. So that's really the big key things on splitting income.
Wonderful. And one common question we get is, if I do gift to my children, can I claim that on my taxes as a gift? Unfortunately not. You can only claim donations to a registered charity with a charity, but it does help reduce your tax payable, as Derek mentioned. So moving on to tax deferral. You can defer receiving taxable income until a later date when you're in a lower tax bracket. So as we mentioned earlier, RSPs provide a tax deduction for contributions, allowing you to defer the tax on those funds until you withdraw them. So typically you would utilize an RSP when you are earning a higher income. So for example, over $60,000. You would then start withdrawing from your RSPs once your income is lower than that, so less than $55,000, for example. Looking at a more complex strategy that we've used for quite a few clients of ours is a vendor take-back mortgage. This allows you to spread out the realization of capital gains from selling an investment property, for example, over multiple years. So we've used this strategy with our clients that have looked to sell their cottage to their children. So say there is a $250,000 capital gain on the cottage. With this strategy, you would be able to spread the gain out at $50,000 gross capital gain. As Derek explained earlier, only 50% of capital gains are included on your income. So $25,000 would be taxable income per year over the next 5 years, versus claiming the lump sum of $250,000 gross, $125,000 taxable, which would likely push you into the highest or at least a higher tax bracket than what you're currently in. So those are a couple ways to defer taxes. Now let's look at the last D, diminishing.
Diminishing. I think you're talking about me, that my role is diminishing and yours is increasing.
Absolutely not.
Anyhow, the whole idea of diminishing taxable income is there any way we can rearrange our investments or our income so that we report less on that taxable income line? So we can maximize our tax advantaged investments in a number of ways. And in any one situation, again, especially if it's a smaller amount, it doesn't make a lot of difference, but these little things add up. So let's take a very simple example of somebody that's in, say, a 50% stock portfolio, 50% bond portfolio using individual stocks or mutual funds. We're licensed for mutual funds. So We know that RIF money is 100% taxable. Tax-free accounts are completely tax-free. And then if we have an investment account, well, it depends if we're earning dividends, interest, or capital gains, which would be most tax effective. So in this simple example, we want to keep the overall portfolio at 50% stocks, 50% bonds, but we also want to minimize the tax payable. So a strategy that we commonly use is we would put all of the bonds inside the RIF, or inside the RIFs or the RSPs, because once we got the initial tax savings, we really don't want them to grow that much, because the more they grow, the more taxable income they're going to throw out when you start withdrawing from it. So we need to have some place to put our safer or lower growing money. So we put that inside the RIF, inside the tax-free savings account. There's never any tax, so we want that to grow as big as possible. So we would put all the stocks, which typically grow the most over the long term. And also it shelters dividends in there so they don't get grossed up to a higher amount inside or on our taxable income. If there's any amount left in the taxable investment account, well, it's used whatever stocks or bonds to provide the balance to end up with our overall portfolio at 50-50. Everybody's situation is a little bit different, and we can't always do it exactly that way. And if you have need for some money in the short term, again, we might not be able to do it exactly that way. But that's the goal, is to have as little as possible income from your investments show up on your tax return each year. So the other thing, if you're still in your earning years, as we talked about, even like with the case of our young friend Brian, $60,000 of income, we would only recommend $5,000 go into an RRSP, because after that, he's in the lowest tax bracket. So why bother putting it there? Put it into his TFSA instead, or even into an open investment account. And when he gets a higher salary, then we can use more money from that to get a bigger tax break. There are some mutual funds that have set up a corporate class, and this is for a few people that have very large taxable investment accounts. This can be advantageous. We have to be careful with that, though, because a corporation, unlike a mutual fund trust, how most mutual funds are set up, will pass through to you on the tax slips any interest, any foreign dividends, any capital gains that they earned within the portfolio. A corporate class mutual fund is set up as a corporation. It can't pay interest. So it can pay dividends or it can pay capital gains. And so, again, that can be beneficial to certain people. We have to be, again, careful if you're drawing old age security, because remember, the dividends get grossed up by 38%. So we don't want a lot of dividend income coming in as well. So again, there are a few cases where that's beneficial. If you're one of the handful of people, I guess there's quite a few people actually, that have corporations, you have to decide what the right mix is between taking a salary or taking dividends. Because as you saw from our example, you can pay a lot less tax if you're taking dividends, especially if they're eligible dividends. Most people, if they own their own corporation, that would be the non-eligible dividends, not quite as beneficial, but you still could do that. One caveat, though, to business owners, if they take everything in dividends, that means they're making no CPP contributions. So they'll get 0 CPP when they retire. And they'll also have no RSP room to contribute to an RSP to be able to draw out and be able to split pension income with a spouse later on. So again, everybody needs to take a look at those kind of things. And while it's not technically diminishing taxable income, it can, in a sense, like we talked a little bit about giving money away to children or grandchildren. You can also donate money to charity. And that doesn't, I mean, if you're donating money, it's coming out of your portfolio somewhere, so you'll have less income to report, but it gives you some outsized tax credits, which I believe we're going to walk through on the next slide. So I'll let you go through this, Chelsey.
Yes, so we briefly talked about charitables before, but we're going to break it down a little bit because it is one of the unique tax credits. Typically, tax credits are just based on the lowest federal and provincial tax brackets. However, there are different categories for donations. So on the first $200 of donations that you make, you receive the minimum federal tax credit of 15%, just like the other credits. However, if you graciously donate over $200, you then receive a 29% federal tax credit if your income is less than 200,000. And if your income is over 200,000, you receive a higher tax credit, which is 33% of your donation. Now, the government doesn't want you to go crazy with donations, so they have set a limit of 75% of your net income that you can donate and claim. However, the only caveat here is if the taxpayer passed away in that tax year, they can actually claim 100% of their net income on their final tax return. Just breaking that down a little further, there are a federal and a provincial tax credit. So we'll show that here to provide the overall tax savings. So looking at the far left there, it shows under 200 at the top. So any amount under $200 that you donate, you'll receive the federal and provincial tax bracket of 15% and 5%, giving you a total tax credit of 20%. Now for amounts over $200, we'll focus on if your income is less than 200,000, you receive a federal tax credit of 29% plus the provincial tax credit of 11%, providing you with an overall tax credit of 40%. And then far right, if your income is over 200,000, you receive the federal tax credit of 33% plus the provincial of 11%, giving you a 44% tax credit. So especially helpful if your income is in the higher tax brackets, you could essentially save almost 50% in taxes. However, for just a simple example, if you donated $1,000, you would save about $360 in taxes if your income's under 200,000. So very helpful. Now, there are a few different ways that you can donate. One, the most common that people are most aware of is through cash. However, there's actually a more tax efficient way by gifting securities, which Derek will walk through for us.
Great. Yes, writing a check is easy. However, we've been able to help a number of clients that have been with us for a number of years and have significant capital gains in their portfolio. They want to give. And so we say, well, how much do you want to give? Let's give the shares from your mutual funds to the organization. And there's a special exemption when you gift money away. You don't have to report the capital gain at all. So we're going to run through here. Chelsey's going to put up some numbers and we'll walk through an example. So we bought these mutual funds for $20,000. The current value is now $100,000. You call me up and say, I'm going to write a check. Can you cash in $100,000 worth of funds and figure out what the tax is going to be? And then I'll donate the rest to the charity. Well, you would have an $80,000 capital gain, which would be $20,000 in taxes on the capital gains. So when you complete that, you'll only have $80,000 to give, and your tax credit would be anywhere from the lower amount would be $32,000 if you're in a lower tax bracket, but if you're in the high tax bracket and you include the surtaxes that you're avoiding, you're saving basically 50 cents on the dollar. So now rather than doing it, if I hear you say that, I'll say, well, look, rather than cashing in the $100,000 and sending it to your bank account and having you pay the tax on it, why don't we just send the $100,000 over to the charity? You still have the $80,000 capital gain, but there's a special exemption, goes back on that tax form. You don't have to report that capital gain to the tax man. So you donate the whole $100,000 to the charity, and you get a $50,000 refund. So again, a significant benefit to gifting securities. And we do have many clients that have had open accounts that they've had with us for a number of years, and there's significant capital gains. This is also a great thing to do if you've sold a cottage and you have some investments, or even if you're looking to offset the cottage. Donations are a great thing to do to help offset the capital gains on the cottage. You may not have securities to donate, but at least you could donate something. And if you've got a large capital gain on the cottage, you can see where it would save you almost 50 cents on the dollar for everything that you donate. So that's a lot of numbers, but the bottom line is if you're thinking of donating and you've got an open investment account and there's some capital gains on it, talk to us about that first, because it would be more beneficial to give from your investment account than from your bank account.
Wonderful. Perfect. So that covers off that section. Now we're going to move into our year-end tax optimization process and some considerations to keep in mind before year-end. So typically do our tax optimization with our clients in the fall, as that's where we have our best estimate of their income for the year. And we're going to walk through just some steps of what we look at and things that we do. So we review your previous tax returns. We look at your estimated income and deductions to create a projection of your expected taxable income. We then review your financial plan and goals to assess your cash flow needs. So some questions that we ask is there any large expenses on the horizon? And then do we have enough tax efficient cash to fund them? Next, we identify your optimal level of taxable income required to fund your goals. We annualize your tax liabilities and potential sources of taxable income, and we confer with your accountants where needed. And then lastly, we finalize our projection and we provide some recommended actions. Some of those recommended actions could involve withdrawing additional money from your RIF, triggering some gains to bring taxable income to the top end of the lowest tax bracket, which in 2024 is about $55,000 each of taxable income. And while this strategy involves paying a little bit more tax now, it typically saves you in quite a bit of taxes over the long run. And we're going to walk through an actual example of that shortly. So that's taking money out of your RIF, but some of our tax minimization strategies could also involve additional RSP contributions to help reduce your taxable income. Or we can trigger some capital losses. Capital losses can be carried back 3 years, or you can even carry them forward if you don't need to claim them in the given year. Or we can consider making a charitable donation to help reduce your tax payable as well. So let's look at an actual projection here. So we do have actual accountant software, tax filing software. And while we don't actually file taxes for our clients, we do use the software to make projections. So we typically look at a couple different scenarios, maybe 3 or 4, depending on the situation. In this case, we have 2 scenarios. Scenario 1 is with current income with no additional tax minimization strategies. And then scenario 2 shows us withdrawing an additional lump sum out of our client's RIF to bring the couple's taxable income up to, but not over, the old age security clawback limit, which we talked about earlier was just under $91,000 each of net income. So you can see the taxable income, or the net income in this case, is about $87,000 each. We do typically like to leave a little wiggle room just in case there's any unexpected income we didn't account for. And one thing to point out is for these extra RIF withdrawals, we can choose the optimal amount of withholding tax to take off to optimize our client's refund or tax owing. The minimum amount we have to take off is 10%, but we can also withhold as high as 100% if we see that being the best option. Some clients prefer not to pay a large tax bill in the spring, so in that case, we would withhold more from their RIF. Like in this scenario, we are withholding 30%, and when we withhold tax, we send it directly to the CRA to prepay our clients' tax bills. Now, this is the same strategy, but looking at the credits and the federal and provincial taxes, and looking at the bottom line, how much we expect the client to owe in the spring. So if we look at the very bottom, it's highlighted in yellow, the balance due or refund. in scenario one, if we didn't utilize any other tax minimization strategies, we'd expect the household to owe about $4,000. Versus scenario two, where we take out additional RIF and send a chunk to the CRA, we only expect them to owe about $700 between the two. So that's one scenario. There are so many different scenarios that we've ran for our clients. As we know, everybody is unique. So one of the questions that we get sometimes with these scenarios is, why am I paying more tax now? Why not wait till later? And Derek is going to walk us through that now.
So the big thing comes is, again, going back to the marginal tax brackets, and this works especially well. We're dealing with many couples where we can split taxes, because as soon as one of you passes away, there's no longer any ability to split income. And so paying a little more tax now, if we can take money out and you're in a very low tax bracket, that prevents the situation of passing away and having huge amounts in your RIF, which will automatically move you up into a higher tax bracket and pay a lot more. So here's a simple example of one client that we worked this with a few years ago, over a period of 2 or 3 years, taking a little bit extra money out of their RIF. So if we would have just taken the minimum amount and then the estate paid the rest, they would have paid $43,000. We took out a little bit extra, paid lowest amount that we could. We ended up paying more tax on an ongoing basis, but there was basically nothing left to pay for the estate. So they only paid a total of $33,000, saved them $10,000 over a period of about 3 years. And so this is, again, one of the things that we do, especially for people that have the ability to split pensions and they've got larger RRSPs or RIFs as they get older. We've been able to wind down quite a number of clients' RIFs, and they're going like, boy, my taxable income really dropped down. This is wonderful. And so that's, again, one of the things that we look at is, how can you get out from under the tax man long before you leave this planet? So let's take a look at some year-end tax considerations. So there's certain things we have to do before the end of the year to qualify for 2024. Charitable donations, ideally, again, with appreciated securities before December 31st. And a lot of these things, we need a little bit of time to process them, so please don't wait till Christmas Eve. We review investment portfolio, see if it's worthwhile to trigger capital gains or capital losses. Again, those have to be done by the end of the year. TFSA withdrawal, if you need some money coming up, especially if it's going to be right now or early in the new year, if we take it out of the TFSA, we don't trigger any taxes for this year, but then in January, we can replenish that by doing something, and we've at the very least, we deferred taxes for another year. RESP contributions for your children or grandchildren, that's got to be done by the end of the year. RSP contributions, we have until March 1st of next year, so that's not as much of a rush. But if you're taking advantage of the new first home savings account, those contributions do have to be in by December 31st. And of course, if you haven't maximized your TFSA, we really encourage people to maximize that as soon as they can. So Chelsey's going to walk into talk a little bit about some of these things in a bit more detail.
Yeah, so TFSAs have been around for quite a while. They were implemented in 2009, but I'm just going to go through some of the main key details. So, of course, as in the name, withdrawals are tax-free. So if you ever need to access your TFSA, completely tax-free. If you do make a withdrawal, you can put it back in the following calendar year, in addition to the following calendar year's extra contribution limit. So looking at an example, if you need to take out, say, $50,000, do it before December 31st. You can then recontribute that $50,000 back into your TFSA on January 1st of 2025 or later. And then you can also contribute the 2025 TFSA contribution limit, which we expect to be $7,000 again. So essentially, you take out 50 now, you can contribute 57,000 in 2025. So one key point If you do expect to withdraw or need funds from your TFSA within the next 6 months or so, we advise to take it out of your TFSA before December so that you're able to then recontribute it when you come into more funds in the following calendar year. Now, you have to be 18 years old in order to open and contribute to a TFSA. The 2024 TFSA limit is 7,000. So if you have a child or a grandchild that has turned 18 in this calendar year, you can contribute, or they can contribute, the full $7,000 this year to a TFSA. If you were 18 prior to 2009, you would be able to contribute a cumulative total of $95,000 into a TFSA. So it's important to maximize your contribution room. If you have a spouse, make sure their contribution room is maximized. And if you have an adult child, making sure they also maximize their contribution room to fully utilize this vehicle. Now, we've talked about withdrawing from an RSP or RIF previously, but we're going to just drill down in a little bit more detail. So if you expect your income to be low in the year, less than $55,000 each taxable, you may consider withdrawing from your RSP or RIF to bring your taxable income up to, but not over, the next lowest tax bracket. So for example, if your taxable income is 40, you might want to consider taking out an additional 10 or 15,000 from your RSP to bring it up to that tax bracket. There's also a $2,000 pension income credit, but you have to be at least 65 years old in order to claim it. So if you're 65 and over and you don't have income from an actual pension to claim that pension credit, you can either convert a portion of your RSP or RIF to produce an annual income stream of at least $2,000 to then claim that $2,000 offsetting pension income credit. Another strategy, again, only if you're 65 plus, if you have a lower income spouse, you may consider converting your RSP to a RIF to enable pension splitting with them. And lastly, the first home savings account is a newer vehicle. It was implemented late 2023. Again, only applicable to Canadians that are 18 years or older. And it's geared towards new homeowners. So you can't have owned a home at any time in this year or any of the 4 preceding calendar years. You can contribute a maximum of $8,000 per year, and the contribution limit is carried forward. So if you don't maximize this year, you can maximize double next year. The lifetime limit is $40,000, and we like to call it a hybrid between a TFSA and an RSP, as the account is not taxable. However, when you make a contribution to a first home savings account, you receive a tax deduction. So those are just some considerations to keep in mind as you're doing your year-end tax optimization. And now we're going to briefly talk about some changes in tax laws for 2024.
All right. The big one we've already mentioned, so we'll just sort of recap that the capital gains inclusion rate changed from 50% prior to June 25th to 2/3 for after June 25th. And again, that scared a lot of people, but it only applies on the amount above $250,000 per person per year. So again, typically it's only if you've sold a rental property you've had for a long time, a cottage, a business, something like that. If you've got that problem, give us a call, because it doesn't affect that many people, but it did scare a lot of people. And then, again, triggering capital gains or losses on investments. One benefit of triggering a capital loss, if there are any. Of course, with us, you never have capital losses. Say that tongue in cheek because we do have capital losses some years. But if you do have capital losses and you paid a lot of tax in prior years because of capital gains, you can carry them back 3 years and get a refund of that money. Or if you're in a low tax bracket, we would recommend triggering some capital gains just to pay a low rate of tax on that and prevent larger tax bills in future. Also affects private corporations. Again, not everybody has a private corporation, but the change to the capital gains was more significant to them because they have no $250,000 base. 2/3 of capital gains from June 25th on are considered included for tax purposes. And that also affects the capital dividend account, which is basically because the corporation is paying tax and then ultimately the taxpayer pays tax. Formerly, the 50% that was tax-free, that wasn't reported, would be able to be flowed out to the owners of the company, tax-free via the capital dividend account. So that will be reduced to only 1/3 because now 2/3 have been taxed. And that again will have some implications for those people that own corporations. And I think those are the real key changes. Yes, their disclaimer.
That was the main change. Now, we're getting into questions now. So we have about 5 minutes left till the end of the webinar. So we have received some questions from pre-submissions and also during the webinar. So we'll start with one, charitable donations as a tax strategy. Now, we have spent a lot of the webinar on charitable donations, and they are a great tax strategy to use if you have tax owing. So as Derek mentioned, if you sold a cottage in the year and you have large capital gains, charitable donations can be a great way to offset those gains. Or even if you owe 5,000 or 10,000 in just a regular year, you can make charitable donations to offset those taxes as well. Another question.
Just to add on to that, and remember how we talked about deductions were better than credits, with the exception of the charitable credit. Because even if you're making $90,000, if you are still working and want to make an RSP contribution, you actually get more of a refund by contributing $10,000 to a charitable organization. Now, the bad news is that it's no longer your money. You don't have it in there that you can draw on later on. But from a pure tax standpoint, $10,000 in donations will give you a greater tax deduction than a $10,000 RSP contribution if your income is $90,000, because you're in that middle tax bracket. You're getting a 40% or better tax saving from the donation, but you're only going to be getting about a 32% tax saving from an RSP contribution.
Perfect.
Yeah.
Another question with regards to RSPs. So best time to start accessing RSPs once you're retired. So biggest thing on this is we look at your tax bracket. If you retire and you don't have pension income, then we'd likely start withdrawing from your RSP right away to bring you up to the top end of that lowest tax bracket, which is about 55,000 taxable income. However, if you do have a pension, maybe you're into the mid tax bracket, we could potentially look to start withdrawing from your RSP enough to still keep you under the old age security clawback. Derek's have some extra points on that too. Yeah,
just what we look at is we look at the taxable income for the year. We had a client that we just actually recently dealt with. They went off on like workers' comp or something equivalent because of an illness. So they have no taxable income for a significant portion of the year. So we actually withdrew some money from their RSP. They're not retired. They're planning still to go back to work, but we're in a low income year. Where else can you take out money out of your RSP? So if you go back to school, if you have a year that you've taken a sabbatical or something and have very low income, doesn't matter if you're 40 or 70, we often will recommend to take money out of your RSP, especially if you haven't maximized your tax-free savings account or have some mortgage to pay down. So again, we look at what's the amount, what's the taxable bracket that you're in, and when would it be good to take this money out?
Yes.
And then I'll start and you can, so there's a question about, are government credits added to increase annual income? So there's a lot of lingo in our financial services area. Why don't you bring the screen up so that you can see our face a little bit maybe?
Oh, sure.
So I'm not 100% sure about the what do you mean by credits, but if you mean old age security, CPP, anytime the government sends you.
I did clarify that actually, and they meant the like carbon action rebates, things like that.
Okay, so those kind of credits, no, they don't get added to your income, but when you receive old age security, CPP, anything like that from the government, yes, it gets added onto your taxable income. But if you're receiving a credit like the carbon tax, These other things that come up for there's age benefits, Ontario Health benefits. There's a few other credits that you get paid out, a GST, HST, I guess they call it, HST rebates. Those are not taxable.
Yes. Another question, if my donations to charities are too high for the year, can the charitable receipts be given to family members for them to claim? To my knowledge, but Derek can confirm, no, you cannot transfer charitable receipts. However, if you can't claim them in that tax year, you can carry them forward for up to 7 years.
5 years. Sorry.
5 years.
So you can split with your spouse, but not anybody else in your family. And yes, you can carry them forward up to 5 years. So a great example, we had a client that passed away a couple of years ago, had a fairly significant estate, fairly big tax bill, but they had also included some donations in their will. And I think Chelsey mentioned it earlier, in the date of death, you can actually have charitable donations that go up to 100% of your net income. So we were able to actually eliminate all of the federal tax owing. Provincial tax is a little bit different and their credits don't go quite the same. So there was still some provincial tax owing, but she ended up, her state ended up getting a refund for the year that she passed away. And there was charitable donations that were left over. We were actually able to work with her accountant, and they went back 2 prior years and got additional refunds from those prior years because you're allowed to use them up. So again, another great reason for charities to fit into your financial planning through your will or on an ongoing basis.
And lastly, one last question for the first home savings account. We mentioned they must be Canadian, but does that mean Canadian resident? And yes, they do have to be a Canadian resident in order to qualify for the first home savings account and the TFSA.
Great.
All right, so that wraps up the webinar. Again, we are going to be sending a recording of the webinar, so if you'd like to rewatch or forward to any friends and family, please feel free. We are also present on social media, on Instagram, Facebook, LinkedIn, and YouTube. So we do post weekly content on there for financial literacy, so please feel free to give us a follow. And I'll let Derek close us off here.
All right, well, thanks so much. Go out and enjoy this wonderful afternoon that we're having. Beautiful summertime weather in early November. It's wonderful. So thanks for joining us. Have a great day. And if you got any questions, reach out to us afterwards. Bye for now.
Bye.